Hello everyone and welcome back to the 10th installment of the Beginner Tutorial series. Over the past several modules, we've built a comprehensive foundation. You understand currency pairs, the instruments we trade. You understand pips, the universal unit of movement. And you understand lot sizes, the volume of exposure that determines how much each pip movement is worth. But there's one more essential piece of knowledge that connects all of these concepts to your bottom line. It's the cost of putting it all together. It's the toll you pay to access the largest financial market in the world. I'm talking about the spread. Every market has a cost of entry. In stocks, you pay a commission to your broker. In real estate, you pay agent fees and closing costs. In Forex, the primary cost is the spread. It's embedded directly into the price you see on your screen. Now, here's the important thing. A trader who ignores spread is like a driver who ignores fuel consumption. You might be going in the right direction, but if you don't account for your costs, you'll eventually run out of gas. Understanding spread is not just about knowing what it is. It's about respecting it, minimizing it, and factoring it into every trading decision you make. By the end of this presentation, you'll understand exactly what spread is, why it exists, how it varies across different pairs and sessions, and, most importantly, how to minimize its impact on your trading account. Let's start with a fundamental question. What exactly is spread? In Forex trading, the spread is the difference between the bid price and the ask price of a currency pair. It is the primary transaction cost that you, as a trader, pay to enter and exit the market. But why does spread exist? Why can't we just trade at a single price like we do with stocks on an exchange? There are three main reasons. First, liquidity provider compensation. Banks and market makers quote two-way prices, a bid and an ask, and they take on risk by standing ready to buy or sell at those prices. The spread is how they are compensated for providing the service. They're essentially acting as a counterparty to your trade. Second, transaction cost. Think of it as a fee. Just like a currency exchange kiosk at the airport charges a fee for converting your money, and they hide that fee in the difference between their buy and sell rates, the Forex market's transaction cost is embedded in the spread. Third, risk premium. During periods of uncertainty or high volatility, spreads widen. This is because liquidity providers need to be compensated for the increased risk of taking the other side of your trade. Let me give you a simple analogy that makes this concrete. Imagine you're at an airport currency exchange kiosk. You see a sign that says, "We buy euros at 1.1050 and we sell euros at 1.1080. If you want to buy euros, you pay the higher rate, 1.1080. If you want to sell euros, you receive the lower rate, 1.1050. The difference, 30 pips, is the kiosk's profit. It's their spread. The Forex market works exactly the same way. The only difference is scale. In the interbank market, spreads are measured in fractions of a pip, not 30 pips. But the principle is identical. The spread is the cost of accessing the market. Now, let's look at the two sides of every quote. This is fundamental to understanding how you enter and exit trades. Every currency pair quote has two prices, the bid and the ask. The bid price is the price at which the market is willing to buy the base currency from you. If you want to sell a currency pair, if you're going short, you will receive the bid price. The bid is always the lower of the two prices. Think of it as the wholesale price if you're selling. The ask price, sometimes called the offer price, is the price at which the market is willing to sell the base currency to you. If you want to buy a currency pair, if you're going long, you will pay the ask price. The ask is always the higher of the two prices. Think of it as the retail price if you're buying. Now, here's a crucial concept that every new trader needs to understand: the immediate loss. The moment you enter a trade, you are immediately at a loss equal to the spread. Let me show you. You decide to buy euro to US dollar. The ask price is 1.1048. That's what you pay to enter. At the exact same moment, if you wanted to sell that position back, you would receive the bid price, which is 1.1045. You are instantly down 3 pips. If you're trading a standard lot, 100,000 units, each pip is worth $10. That means you're immediately at a $30 loss. Before the price moves even 1 pip in your favor, you're already in the hole. This is not a flaw in the market. It's the cost of doing business. Your job as a trader is to overcome this initial hurdle with price movement in your favor. The larger your target, the easier it is to overcome the spread. The smaller your target, the more the spread eats into your potential profit. Let's put this in context with a concrete example and look at how spread is displayed on your trading platform. Here's a typical quote for euro to US dollar. You'll see the bid at 1.1045 and the ask at 1.1048. The spread is simply the difference. 1.1048 minus 1.1045 equals 0.0003, which is 3 pips. For yen pairs, the calculation is the same, but with different decimals. US dollar to Japanese yen with a bid of 150.00 and an ask of 150.05 gives a spread of 0.05, which is 5 pips. Now, how do you actually see the spread on your platform? There are a few different ways. Method 1. Visible in the quote. Most platforms show the bid and ask side by side in the Market Watch window. Method 2. Visible on the chart. Some platforms display both prices directly on the chart, often with a shaded area between them representing the spread. Method 3. Spread indicator. Many platforms have a dedicated indicator that shows the current spread in pips. This is especially useful for monitoring when spreads widen. Method 4. Order ticket. When you go to place a trade, the order ticket will show you the current bid and ask, and often displays the spread explicitly. On some trading platforms, you'll find the spread displayed clearly in all these locations. There's no guesswork. You know exactly what you're paying before you click the button. Not all spreads are created equal. There are two main types of spreads offered by brokers, and understanding the difference is important for choosing the right broker for your trading style. Fixed spreads remain constant regardless of market conditions. They are typically offered by market maker brokers. The advantage is certainty. You know exactly what you'll pay on every trade, even during volatile news events. The disadvantage is that fixed spreads are usually wider than variable spreads during normal market conditions. Also, some fixed spread brokers may give you quotes during volatile periods, meaning they reject your order and offer a different price. Fixed spreads are best for beginners because they offer predictability and simplicity. When you're learning, you don't want surprises in your trading costs. Variable spreads, also called floating spreads, fluctuate based on market conditions. They are offered by ECN and STP brokers, electronic communication network, and straight-through processing. The advantage is that during normal market conditions, spreads are often much tighter, sometimes as low as 0.1 pips on euro to US dollar. The disadvantage is that during major news events, spreads can widen dramatically, sometimes 5 to 10 times their normal size. Variable spreads are best for experienced traders who want true market pricing and lower costs, and who understand how to manage around news events. Now, let's look at the key factors that cause spreads to vary. Whether fixed or variable, all spreads respond to these factors. Liquidity is the biggest factor. Higher liquidity means tighter spreads. Euro to US dollar, the most liquid pair, has the tightest spreads. An exotic like US dollar to Turkish lira has much wider spreads because there's less trading volume. Volatility widens spreads. When the market is calm, spreads are tight. During high-impact news like non-farm perils, spreads widen as liquidity providers protect themselves. Trading session matters. During the London-New York overlap, when two major financial centers are open simultaneously, liquidity is at its peak and spreads are tightest. During the Asian session, spreads on European pairs are wider. Economic news is a major factor. Spreads typically widen 15 to 30 minutes before a major release and normalize 15 to 60 minutes after. Currency pair type determines baseline spreads. Majors are tightest, minors are moderately wider, and exotics are widest. Broker type matters. ECN/STP brokers typically offer tighter spreads than market makers because they pass through interbank pricing. Let's look at some actual numbers. These are typical spreads you can expect on an ECN or STP broker, the kind that Algonic recommends and integrates with. First, by currency pair. Euro to US dollar is the tightest, with spreads often as low as 0.1 to 0.3 pips. This is why it's the most popular pair for scalpers and day traders. US dollar to Japanese yen is also very tight, typically 0.2 to zero point 0.5 pips. Pound sterling to US dollar is a bit wider, usually 0.5 to 1.2 pips, because it tends to be more volatile. For yen crosses like pound sterling to Japanese yen, spreads are wider, 1.5 to 3 pips, because these pairs are more volatile and slightly less liquid than the majors. For exotics, spreads vary widely. US dollar to Mexican peso, the most liquid exotic, might trade at 3 to 8 pips. USD/TRY can be 5 to 15 pips. And some exotics like US dollar to Argentine peso, the Argentine peso, can have spreads over 100 pips. These are not pairs for short-term trading. Now let's look at spread by trading session. This is crucial for knowing when to trade. During the Asian session, Euro to US dollar spreads typically run 0.3 to 0.8 pips. This is a good time to trade Asian-focused pairs like US dollar to Japanese yen, Australian dollar to US dollar, and NZD/USD. During the London session, spreads tighten significantly. Euro to US dollar often drops to 0.1 to 0.3 pips. This is prime time for European pairs. During the New York session, spreads remain tight, especially during the overlap with London. US dollar to Canadian dollar is particularly active during the session. The London-New York overlap from 8 a.m. to noon Eastern Time is the absolute sweet spot. Spreads on all majors can go as low as 0.1 to 0.2 pips. This is the best time to trade. The weekend open, Sunday evening, is the worst time for spreads. Liquidity is thin, and spreads can be 1 to 3 pips or more on majors. Many experienced traders avoid trading during this period. One of the most important things to understand about spread is how it behaves around major economic news releases. This follows a predictable pattern that every trader should know. Let me walk you through the 3 phases of spread behavior around news events. Phase 1, pre-news, about 15 to 30 minutes before a major release. Spreads begin to widen. Liquidity providers start reducing their risk exposure because they don't know what the news will say. Many experienced traders will exit positions before this phase begins. If you're still in a trade during this period, you're at risk of facing a much wider spread if you need to exit. Phase 2, the instant of the news release. This is when spreads are at their maximum width. They can be 5 to 20 times larger than normal. For Euro to US dollar, a normal spread of 0.2 pips might widen to 2 to 5 pips or more. Slippage, where your order fills at a worse price than expected, is common. Many brokers explicitly warn against trading during this exact moment, and for good reason. The risk of adverse fills is very high. Phase 3, post-news, about 15 to 60 minutes after the release. Spreads begin to gradually normalize. The market has digested the news and liquidity returns. However, volatility often remains high. This is when many professional traders start looking for opportunities, not during the initial spike, but after the market has settled and spreads have normalized. What kind of news events cause this pattern? The biggest ones include non-farm payrolls, NFP, the U.S. jobs report released on the first Friday of every month. CPI, inflation data from major economies. Central bank rate decisions from the Fed, ECB, BOE, and others. GDP reports, quarterly economic growth data. Employment reports. Various countries have their own jobs data. The key takeaway: if you're new to trading, it's often wise to avoid trading during the pre-news and instant news phases. Wait until the market has settled and spreads have normalized. The extra pip or two you save on spread can make a significant difference over time. Now, let's talk about the true cost of spread, not just in pips, but in actual dollars and as a percentage of your trading capital. Let's start with a simple calculation. You're trading Euro to US dollar with a spread of 0.3 pips. For a standard lot, each pip is worth $10. So your cost per trade is 0.3 times $10 equals $3. Now, let's scale that up. If you make 10 trades a week, that's $30 in spread costs per week. Over 52 weeks, that's $1,560 per year. If you're trading with a $10,000 account, that's 15.6% of your capital, just in spreads. And that's before you account for any losing trades. This is why spread matters. Every dollar you pay in spread is a dollar that can't compound. Spread costs directly reduce your compounding potential. Now, let's look at how different broker models affect your costs. I've laid out a comparison for a standard lot of euro to US dollar. A market maker broker with a fixed spread of 1.5 pips and no commission costs you $15. Simple and predictable, but expensive. A spread-only ECN broker might offer 0.8 pips with no commission. That's $8 per trade, a significant saving. A raw spread plus commission broker might offer spreads as low as 0.2 pips, but charge a commission, say $7 per standard lot round trip. That totals $9 per trade, slightly more than the spread-only ECN in this example, but often cheaper when spreads widen. An ultra-low plus commission model might offer 0.1 pip spreads with an $8 commission, also totaling $9. So, which is better? It depends on your trading style and account size. For small accounts trading micro lots, spread-only models are often better because fixed commissions become expensive relative to the pip value. For large accounts trading standard lots, commission-based accounts with raw spreads are almost always cheaper. For scalpers, a commission-based account with ultra-tight spreads is essential. A 1 pip spread on a spread-only account can eat up 10 to 20% of a scalper's target. For swing traders, either model can work because you're holding trades longer and targeting larger moves. The key is to do the math for your specific situation. Calculate your average trade size and frequency, and choose the model that minimizes your total cost. Let's get practical. How does spread actually affect your trading, and what can you do to minimize its impact? First, understand how spread affects different trading styles. For scalpers, spread is critical. If you're targeting 5 to 10 pips per trade, a 1 pip spread eats up 10 to 20% of your target. Scalpers need ultra-tight spreads, 0.1 to 0.5 pips maximum. For day traders, spread is important but not as critical. With targets of 20 to 50 pips, a 1 pip spread might be 2 to 5% of your target. Moderate spreads of 0.5 to 2 pips are acceptable. For swing traders holding positions for days, spread is moderate. A 2 pip spread against a 100 pip target is only 2%. You have more flexibility. For position traders holding for weeks or months, spread is minor. Even a 10 pip spread is negligible against a 500 pip move. Now, let's look at the common mistakes traders make with spread. Mistake 1. Ignoring spread in profit targets. Setting a 10 pip target without accounting for a 2 pip spread means you need 12 pips of movement just to break even. Always add spread to your target calculation. Mistake 2. Trading high spread pairs for small moves. Scalping US dollar to Turkish lira for 20 pips when the spread is 15 pips means you need 35 pips just to make 5 pips of profit. It doesn't make mathematical sense. Mistake 3. Trading during spread widening events. Entering a trade just before NFP when spreads are 5 times normal means you're starting with a huge disadvantage. Mistake 4. Not calculating actual dollar cost. Thinking 2 pips is nothing is dangerous. 2 pips on a standard lot is $20. Over 100 trades, that's $2,000. Always convert pip costs to dollar costs. Mistake 5. Choosing a broker based only on advertised spread. The lowest spread might hide execution issues, requotes, or hidden fees. Consider spread alongside execution quality, regulation, and platform features. Now, here are 6 strategies to minimize spread costs. Strategy 1. Trade during peak liquidity. The London session, New York session, and especially the London-New York overlap are when spreads are tightest. Avoid Asian session for European pairs, late New York session, and weekend opens. Strategy 2. Focus on liquid pairs. Prioritize majors, especially Euro to US dollar and US dollar to Japanese yen. If you trade minors, choose liquid ones like Euro to Japanese yen or Pound sterling to Japanese yen during London hours. If you trade exotics, US dollar to Mexican peso is the most liquid. Strategy 3. Use limit orders. Limit orders add liquidity to the market. On some ECN platforms, limit orders may receive better spreads or even rebates. Market orders remove liquidity and pay the full spread. Strategy 4. Consider commission-based accounts for larger sizes. For larger lot sizes, raw spread plus commission accounts are almost always cheaper. Calculate your break-even point. Break-even lot size equals commission divided by spread savings per lot. Strategy 5. Avoid news trading unless you're experienced. If you must trade news, wait 15 to 30 minutes after the release. Let spreads normalize. Trade the reaction, not the release itself. Strategy 6. Scale up gradually. Start with micro lots while you're learning. As your account grows, the percentage cost of spread decreases relative to your capital. But remember, the percentage cost remains the same regardless of account size. Scaling works because your costs don't scale linearly with your account growth. Let's bring everything together. You now have a complete framework for understanding and managing spread in your trading. Here's your spread framework. 5 pillars to remember. First, know your spread. Before every trade, check the spread. Understand what's normal for your pair and your session. Be aware when spreads widen abnormally. Second, calculate the cost. Convert the pip spread to dollar cost for your lot size. Add the spread to your target calculation. Factor the spread into your risk-reward ratio. Third, choose your battles. Trade tight spreads for short-term strategies. Wider spreads are acceptable for longer time frames. Match your pair selection to your trading style. Fourth, optimize your trading. Trade during peak liquidity. Consider commission-based accounts for larger sizes. Use limit orders when appropriate. Fifth, respect the long-term impact. Spread costs compound over time. Every pip you save is a pip you've earned. Small optimizations add up significantly over hundreds of trades. Let me leave you with a key insight that I want you to remember every time you trade. Every dollar you pay in spread is a dollar that cannot compound. Spread costs directly reduce your compounding potential. If you save 1 pip per trade and you make 500 trades a year, that's 500 pips of additional profit or reduced loss. On a standard lot, that's $5,000 a year. And here's the most important truth about spread. In Forex, the spread is the only guaranteed cost. You will not always win. The market might move against you. Your analysis might be wrong. But the spread? You will pay it on every single trade. Every time you enter. Every time you exit. It is the toll you pay for access. So respect it. Minimize it. Factor it into every trading decision you make. Your next steps. With spread mastery, you now understand the cost side of trading. In the next tutorial, we focus on bid and ask price, an essential concept for every trader. You'll understand how orders are filled, why there are 2 prices in the market, and how the spread directly affects your trading performance. Thank you for your attention. If you found this helpful, don't forget to like, subscribe, and follow for more in the beginner tutorial series.